right, once again, good evening.
Good evening, sir.
All right, thank you, sir. We shall be rounding up on financial analysis. We started this topic like 2 weeks back. We look at financial statement analysis. Precisely, we define, excuse me, we define financial analysis as the evaluation of the company's financial statements. Evaluation of a firm's past financial performance and its future financial prospects. This evaluation involves financial statement analysis and the analysis of the cash flow statement. To carry out this analysis, you can use vertical analysis method. The purpose of this analysis is to determine the past financial performance of a company and to project the company's future financial prospects. This analysis enables us, if you carry out financial statement analysis, it enables us to know the financial position of a firm relative to other firms within the industry. We also carry out analysis of the statement of cash flows so as to determine the impact of the sources of cash flows and the uses of cash flow. We carry out evaluation of the statement of cash flow so as to determine the impacts that its success and uses of cash flow have on the firm's operations and the financial conditions. To carry out this analysis, you can do horizontal analysis of the financial statements, what we call trend analysis. Or you can do vertical analysis of the financial statements, or you can carry out ratio analysis. Under ratio analysis, we have liquidity ratios, we have profitability ratios, we have leverage ratios, and we have investors ratio. This ratio can be used to evaluate performance in terms of profitability, in terms of liquidity, and in terms of, please can we mute? Once your speaker conflicts with the class and somebody is touching my screen, Okorie, what's the problem?
No, the whole thing is, I don't know what happened to my screen. We don't want to call it, the thing don't want to adjust. Maybe I'll shut down and start again.
No problem. All right, let's go on. We carry out this analysis so as to determine companies' profitability performance, liquidity performance, and the financial condition of the company. Last week, we were able to treat two questions. We treated question number 1 and question number 2. Tonight, we shall be looking at question number 3. Please refer to page 165. Page 165/166. Question number 3. Eyimba Limited. Please refer to page 165/166. Question 3. Are we good to go, please? Our class governor, Mr. Jamiu, are we good to go? Please, can you confirm you're on that page now?
Yes, we are there, Mr. Shwaju.
All right. I think the governor must have been logged out due to network connectivity. All right, let's go to it. Please, let's check our speaker and ensure that your speaker is muted. Zoom user, please help us mute. All right. Eyimba Limited, a small, profitable, owner-managed business which is seeking finance for a planned expansion. A local bank has indicated that it may be prepared to offer a loan of $100,000 at a fixed annual rate of 9%. Eyimba will repay $25,000 of the loan each year for the next 4 years. Annual interest will be calculated on the opening balance at the start of each year. Please note that statement. Interest is calculated on the opening balance at the start of each year. Current financial information on Eyimba is as follows. Current revenue, $210,000. Operating profit margin. Please, in your question, you are going to adjust that. In the question you have, in your material, you have net profit margin. The appropriate word should have been operating profit margin. So please adjust that. Note the adjustments. Operating profit margin, 20%. Annual taxation, 25%. Overdraft, $20,000. Average interest on overdraft, 10% per year. Dividend payout ratio, 50%. Shareholders funds, $200,000. Market value of non-current assets, $180,000. Next paragraph. As a result of the expansion, revenue will increase by $45,000 per year for each of the next 4 years. Why? Operating profit margin will remain unchanged. No tax allowable depreciation will arise from the investment of amount borrowed. Enyimba currently has no debt. Enyimba Limited currently has no other debt than existing and continuing overdraft, and has no cash or near cash investment. Can you see that? The company does not have debt other than the existing and continue overdraft. What that means is that no long-term debt. Overdraft is a short-term borrowing. And the company does not have cash or near cash investment. Please note this. The non-current assets consist largely of the building from which the company conducts its business. The current dividend payout ratio has been maintained for several years. Requirements A. Assume that Enyimba is granted the loan. Calculate the following ratios for Enyimba for each of the next 5 years. Interest coverage ratio, medium to long-term debt to equity, return on equity, and return on capital employed. Requirement B, comment on the financial implication for Enyimba of accepting the bank loan on the terms indicated above. All right. This question was taken from ACCA. The more reason you have the question in dollars. So we are going to treat in dollars. Assuming Enyimba is granted the loan. Compare the following ratios. Before we can compute, we need to look at the impact of the loan on the company's financials. The impact of this loan on the income statements, the impact of the expansion on the income statements, and on the statement of financial position. Then we can now calculate the ratios. Please, Mr. Eunice Osai, please can you mute? Thank you, sir. Let us look at the loan. This is revenue. Revenue for simplicity. Now let's go to it. In the current year, what is the revenue amount? Let me pick my pen. Let's go to this. Oh, that's good. Okay, Okorie is back.
Yes, sir.
All right. Current financial information. Current revenue. $210,000. Now look at the next note. As a result of the expansion, revenue will increase by $45,000 per year for each of the next 4 years. Let's go to this. Revenue in the current year, $210,000. This will increase by $45,000 each year. That means revenue in year 1, 45 plus 210. What do we have, please?
255.
We have $255,000. Next, in year 2, $255 plus 45.
That's 300.
We have $300. $300,000. In year 3, plus 45.
345.
$345,000. In year 4, plus 45.
390.
$390,000. In year 5,
435.
$390.
No, year 5 will
Examiner
not
says
435.
435.
just hold on. Examiner says revenue will increase for next 4 years. Pay attention to the examiner instruction.
That's true.
Revenue will increase by $45,000 per year for each of the next 4 years. Look at it. Year 1 revenue increase, year 2, year 3, year 4. In year 5, the revenue will not increase again. We have gotten revenue. For each for the 5 years, for the next 5 years. Next, our operating profits. Examiner says operating profit margin 20%. What is operating profit margin? 20% of your revenue. Operating profit margin means profit margin from revenue. 20% of your revenue is your operating profit. And examiner says operating profit margin will remain unchanged. That means 20% remain unchanged. Let us compute our operating profits. 20% of our revenue is equal to operating profit margin. Let's just 1 minute. We continue. Play just 1 minute. Let's continue. Let's continue, please. Compute 20% of your revenue. 20% of 210.
$42,000.
Thank you, sir. $42,000. Next.
51,000.
20% of 255.
$51,000.
60.
50 what?
1.
Thank you, sir. $51,000. 20% of 300,000.
60,000.
Thank you. 20% of $345,000.
69,000.
69,000. Next.
$78,000.
Thank you, sir. You have gotten your operating profit. I want to close this. Don't forget, your operating profit is profit before interest and tax. Please don't forget your operating profit. This is the profit before interest and tax. Next, we need to get our interest expense. Next, you need to get your interest expense. We now go to calculation. Let's go to it. We have bank overdraft. Currently, we have bank overdraft. The amount is $20,000. The interest on the overdraft is 10% per annum. We are now planning to take a loan. We are going to obtain the loan in year 1. The interest on the new loan is 9%. Examiner says annual interest will be calculated on the opening balance at the start of each year. So we are going to have two interests: interest on overdraft, interest on new loan. Let's go to this. Our working one, loan amortization schedule. That is, how are we going to repay the loan? In year 1, you are going to take a loan of $100,000. You are going to repay $25,000 at the end of year 1. Your closing balance for year 1 is $75,000. The closing balance for year 1 is the opening balance for year 2, $75,000. In year 2 again, you are going to repay $25,000. Your balance here is $50,000. Closing balance for year 2 becomes opening balance for year 3. At the end of year 3, you are going to pay $25,000 again. Then you are left with $25,000. This becomes opening balance for year 4. Then at the end of year 4, you are going to pay $25,000. Amount is nil. This is the loan amortization schedule, or the loan repayment schedule. Look at the opening balance. Now let us calculate interest. Calculation of interest. Examiner says the overdraft is existing and continuing. Look at it, please. Look at that statement. Eyimba currently has no other debt than existing and continuing overdraft. That means the overdraft is existing. It still continues for the years. We now come here. In the current year, we have not taken the loan. We only have overdraft. Compute interest on overdraft. The overdraft amount is $20,000. The interest is 10%. Please compute. That will give us $2,000. Interest on new loan. In the current year, we have not taken new loan. No interest here. That means in the current year, our total interest is $2,000. In the current year, we have not obtained the loan. We are going to obtain the loan in year 1. We now move to year 1. In year 1, you are still going to pay interest on overdraft. The annual interest is $2,000. $2,000. Please help us to manage your speaker. If your speaker is on, that means we must avoid external interference. Or the best alternative, mute your speaker. Now, new loan. Year one, we have obtained new loan. The interest on new loan is 9%. Interest here is 10%. Now let's go to it. Examiner says interest will be calculated on the opening balance at the start of the year. Look at start of year one. Opening balance is $100,000. 9% of $100,000. Please compute. That will give me $9,000. That means total interest. Interest on overdraft plus interest on new loan. Total interest, $11,000. Year two, interest on overdraft is the same, $2,000. On new loan, 9% of opening balance, 9% of $75,000. Please compute.
6,750.
6,750. 6,750. Totally $8,750. The interest on overdraft plus the interest on new loan, the opening balance. Please, let's put the notes here. Interest on new loan calculated on opening balance, so that you can know how we calculate it. We move to year three. Interest here is 2,000, bank overdraft. Now, interest on new loan, opening balance. Year three, $50,000. 9% of 50,000.
4,500.
4,500. Total year,
6,500.
Year four, bank overdraft loan will not change. For year four, interest on new opening balance, 9% of 25,000.
2,250.
2,250. Totaling 4,250. Year five, interest on overdraft 2,000. At the end of year four, this loan will have been fully repaid. That means no interest on new loan again. This place is nil. This becomes $2,000. We have calculated our interest. Current year 2,000, year one 11, 8,750, 650, Let's go to this. Year 2000. Year 11,000. Year 8,750. Year 6,500. Year 4,500. Is that not?
No, it should be 4,250.
Okay, 4,250. $4,250 and year 2,250. Oh, 2,000, sorry.
Yeah.
You cannot get your profit after tax. Profit before interest and tax minus the interest.
That's
This will give
$40.
me 40,000. This will give me 40,000. This will give me how much? 76 here. Oh yeah.
Yeah, 251,250.
50.
51,250. 51,250.
51,250. Next.
62,500.
62.
500.
500.
Next one, 73,750.
73.
750.
750. You have gotten your profit before tax. Now compute your tax. Examiner says tax rate is 25%. Let's check it again. Yeah, annual tax rate 25%. Please compute 25,000 and 40,000. This should give us 10,000. 10,000. Next.
$12,813 approximately.
12,813 approximately.
15,625.
12,813. Next.
15,625.
15,625.
15,625. Next.
18,438 approximately.
18,438. Next.
19,000.
19,000. You cannot get your profit after tax. Yeah, I have 30,000. Yeah, 30,000.
Year 5, 57,000.
Yeah, what?
Year 5,
57,000.
The one that has 15,625 is 46,875. Yeah, no, the next. Yes, that one. 46,875.
46.
875.
875. Remaining year 2 and year 3. And year 4.
No, year 4. Year 4, 55,312.
55,312.
38,437.
38,437. You have gotten your task. What is the dividend? Let us check it out. Examiner says dividend payout ratio is 15%. Look at the comments here. The current dividend payout ratio has been maintained for several years at 50%. 50% of your profit after tax is the dividend payout. $50 of 30,000. That will give me 15,000.
15,000.
15,000.
19,219 approximate.
219.
Yeah, it's approximated. Yeah.
50% of these.
Year 5, 28,500.
28,500. Year 3 and 4.
Year 4,
20.
27,656.
27,656.
23,438 approximately.
23,
438 approximately. Yes.
Thank you. Therefore, your retained earnings. This is 15,000. This is 15,000. 19 what? 19,218.
218.
Year 5, 28,500.
28,500. 23,437.
Sorry, is that
27,656.
Sorry, the other one, is it
All right.
23438 or 7?
Okay.
We have gotten our retained earnings.
So someone is asking you a question.
I
Yeah,
didn't get that.
I said that one with 23437. Is it 437 or 438? That's the remaining 50%.
And you should answer. You should tell us the question. Answer now. Less 46,875 on this, and give us the figure.
7.
I think she's right. No, this was approximated.
Because you have rounded up. I mean,
Yes.
that's it. So what you are deducting, 46,875 minus 23,438. Give us your answer.
It's correct.
Now, you have prepared the income statement. Your income statement will show your profits, dividend payable, and your retained earnings. You have looked at the impact of obtaining the loan on your income statement for the next 5 years. Look at it. The impact of this loan on our income statement for 5 years. We have gotten operating profit for year 1 to 5. We have gotten interest for year 1 to 5. We have gotten profit after tax and other components of income statement. We now go to your financial structure. Your financial structure is from your statement of financial position. Your financial structure is coming from your statement of financial position. How is the company being financed? Now let us go to it. What is the shareholders' funds? Currently, our shareholders' funds is $200,000. Is that not?
Yes, sir.
We are going to pick that. Shareholders' funds, everything in dollars. This is $200,000. Now let me ask, okay, what is shareholders' funds? What constitutes shareholders' funds? What and what makes up shareholders' funds?
That is ordinary share plus reserve or retained
Thank
earning.
you. Your ordinary shares plus your reserves. That means in the current year, this reserve, this retained earnings is reserves. Examiner has added both share capital plus this reserve. Now in year one, our new reserve is now 15,000. That means shareholders fund in year one, 15,000 retained earnings plus closing shareholders funds, 215,000. That is shareholders funds in year one. The additional reserve generated in year one plus the closing shareholders funds. Just 1 minute. What I'm trying to explain is your reserves for year one, you are going to add it to the closing shareholders fund in the current year. That will now give you shareholders fund in year one, 200,000 plus 15. That will give me 215. For year two, 19,218 plus 215, 215,000 plus 19, oh rubbish. $215,000 plus 19, 218.
You have 234,218.
Thank you. 234,218. For year 3, 234218 plus 23437.
You have 257655.
257
655.
257 655. For year 4, 27656 plus 257655.
285311.
285311. And for the final year, 28,500 plus closing shareholders fund in year 4.
313811.
313811. You have gotten shareholders funds from the current year, year 1, year 2, up to year 5. Now, long-term debt. Let's go to the question. Examiner says, currently, Enyimba has no debt other than existing and continuing overdraft. Overdraft is not a long-term debt. That means in the current year, no long-term debt. In year 1, we are going to borrow $100,000, repayable in 4 years, repayable annually in 4 years. At the end of year 1, the balance on the loan, remember when you prepare balance sheets, it is the closing balance you are going to pick. At the end of year 1, if you take a loan of $100,000, at the beginning of year 1, you now repay $25,000. That means closing balance. The debt at the end of year 1 is $75,000. 50/25. It is the closing balance you are going to pick for your balance sheet. Look at it. Debt here, 75,000. That is the closing balance at the end of year 1. At the end of year 2, $50,000.
I'm sorry, sir.
At the end of year 3, $25,000. Year 4, nil. Year 5, nil. It is the closing balance that will be taken to your balance sheet, your statement of financial position. Yes, Ogechi, your question or your comments?
My question, please. I don't know how we came about this long-term debt. I'm so sorry. I missed that.
I don't know how
We came about this long-term debt. I missed it.
Are you at the start of this question?
Yes, I am.
Okay. So I will take it as if you missed some aspect out.
Yes, sir.
Look at the question, please. That means we have to read the question again. If at the start of the class, you don't know how we get the loan, that means we have to read the question again. Enyimba Limited, a small profitable owner-managed business, which is seeking finance for a planned expansion. A bank has indicated that they be prepared to offer a loan of $100,000 at a fixed annual rate of 9%. Eyimba will repay $25,000 of the loan each year for the next 4 years. So Eyimba will obtain a loan of $100,000. Eyimba will repay $25,000 each year for the next 4 years. We now prepare amortization schedule. You are going to obtain $100,000 loan in year 1. Beginning of year 1. At the end of year 1, you are going to pay $25,000. You are left with $75,000. Next, your closing balance in year 1 is your opening balance in year 2.
What do you? Why did you stress yourself?
Our basket was getting full.
Fool,
BDM, please can you mute? What can we do? We just try to exercise patience. Some question, we just try to manage patience. This person will not tell me, I don't know where you get the loan from. All right. So that is how we derive the loan. At the end of year 1, we have a balance loan outstanding of $75,000. That is the long-term loan debt at the end of year 1. At the end of year 2, we have a outstanding debt of $50,000. At the end of year 3, we have outstanding debt of $25,000. That is how we derive the debt. How that is better.
Yes.
So your capital employed, shareholders' funds plus long-term debt. That is capital employed. Your capital employed is the shareholders' funds plus your long-term debt. So add these two variables together. You have 200,000 here. Addition 215 plus 75. This should be 390. Is that not?
Yes, sir.
Addition 234, 218 plus 500. 284, 218. Addition, please.
$282,655. 282,655.
655. We can calculate our ratio now.
That year one is 290, not 390.
Oh, thank you. We can compute the suggested ratios now. Interest cover ratio. What is the formula for interest cover ratio? Yes, Mr. Ahmed.
Thank you very much, sir. Please, I'm having a serious network issue. I didn't understand how you calculated the shareholders fund.
Okay. At least we can run through it. First, what is shareholders funds? Share capital plus reserves. Is that clear, please?
Yes, sir.
In the current year,
Share capital plus reserve.
in the current year, examiner says shareholders funds is 200,000.
Okay.
That is at the end of the current year. Shareholders funds is 200,000. Year one, we have retained earnings of 15,000. 15,000 in year one, plus the closing shareholders fund in year zero. That will give me 215,000. Current retained earnings in year one, plus the opening shareholders funds. It was closing for current year. Current year is year zero. It was the closing balance for current year. It becomes opening balance for the year one, plus retained earnings for year one. That gave us 215,000. When you get to year two, this year one balance, it was closing for year one. It becomes opening for year two, plus 19,281, 215,000 plus 19,281. Please work that out.
I got it now. You can proceed, sir. Thank you.
Aha. You may be wondering why don't we add 15 to this? Because it has been added already. Examiner says shareholders funds. That means examiner has added the share capital plus the retained earnings to give us 200,000.
For the year zero?
Yes. Because
Okay.
it was called shareholders funds.
Yeah.
That means you have added share capital plus equity reserves. Equity reserve is retained earnings.
Understood, sir.
All right. Now, calculation of suggested ratios. Examiner gave us 4 ratios to calculate. Interest coverage ratio. So my question to the class is, what is interest coverage ratio? How do we compute interest cover ratio?
Profit before interest and tax over interest expenses.
Your profit before interest and tax divided by the interest expense. So let's go to the question. Let's go to our computation. Current year, profit before interest and tax, 42,000. Interest expense, 2,000. Please divide.
21.
Thank you. Year 21.0. Year 1. PBIT, 51,000 divided by 11,000.
4.6.
Are we multiplying by 100?
4.6 times.
Okay.
Year 2. 60,000 divided by 8,750. 60,000.
0.7 times.
Zero, okay. Zero.
No, it's 6.9. 6.9.
6.9 approximately. You can't get zero, madam. 6.9 times.
Year 3, 10.62.
Thank you. That is 69,000 divided by 6,500. 10 point what?
Plus 1. 10.62.
10.3.
Approximately.
And then the
No,
next one.
10.62, sir. 10.62.
That means you have changed the rule. We are maintaining 1 decimal places.
So the next one
Okay.
is point.
Okay, let it be 10.6.
10.6.
Yes, sir. 10.6.
Oh, 10.6. Year 4, yes.
18.4.
8.3 or 8.4.
18.4. The final year. Let's check it.
39.
78,000 divided by 2,000.
39.
39 times. Don't forget, this is calculated in times. Number of times operating profit covers interest expense. The higher the ratio, the better for the company. Interest cover ratio. This is the number of times the operating profit covers interest payments. The higher the ratio, the better for the company. All right. Second ratio, medium to long term debt divided by equity. Your debt for year 0, we don't have long-term debt. This is 0%. Look at it, please. Debt over equity funds. Nil over 200,000. 0. For year 1, 75,000 divided by 215,000 multiplied by 100.
Sell it.
$34.9 or approximate 35.
Approximately
35.
35%.
Yes.
Or you can say 34.88.
Okay.
Or you can approximate, no problem. But you have to maintain consistency. If you are doing 2 decimal places, we have to be consistent. 34.88%. That is the percentage of long-term debt to equity. Year 2, 50,000 divided by 234,218 multiplied by 100.
That is 21.35.
21.35. We can return here 21.35%. Year 3, 25,000 debt divided by 257,655.
57.
9.70. 9.70.
9.7.
9.7%. Year 4 and 5, 0, 0. Look at it, please. No
So
debt, no debt.
Now year 3, I think it's 9.70.
Zero.
Yes.
25,000 divided by 257,655. 257,655.
9.7.
Wow. Wow. 9.7%. 9.70. Wow. How do we get 27?
I don't know. It's when you were writing.
Yeah, we mentioned the right thing for you.
Okay. 9.70%. You have calculated the second ratio. The third ratio, return on equity. Your return on equity is calculated as what, please? Yes. What is return on equity? How do we calculate return on equity?
Can I give it? Can I try?
Oh, why not? You should not try. You should give me the right answer. Because I explained on this platform.
Is it profit after tax over shareholders fund?
You're asking me back. Moses, are you asking me back?
That's the answer.
Is profit after tax divided by shareholders' funds.
All right, sir.
Multiply by 100.
Okay.
Anyway, I gave the formula here, Sha. Look at it here. To guide your notes. Return on equity is profit after tax divided by shareholder funds multiplied by 100. So let's go to it. In current year, Our profit after tax is 30,000. Shareholders' funds 200,000. Please divide.
That is 15.
15%.
Yes, 15%.
15%. Year one. Our profit after tax is 30,000. Shareholders' funds 215,000. Thirty divided by 250. Multiply by 100.
13.95.
Thank you, ma.
38, 437. Oh, whatever. 234, 8.
13.95%. Year one, year two. Profit after tax 38,437.
The answer
Divided by
is
shareholders' funds.
the answer is 16.4.
16.4 what?
41.
16.41%. Year three. 46,875 divided by 257,655.
18.19.
18.19. Okay, I'll note that. 18.19. Year four. 27,656 divided by shareholders' fund.
No, it should be 55,312.
Oh, sorry, 55,312 divided by 285,311.
That is 19.39.
Okay, let's go to it. 18.19, 19.39, then final year, year five.
57,000.
57,000 divided by 313,811.
That is 18.16.
18.16. You have computed your return on equity. This is 1, 2, 3, 4. Return on capital employed. Please, what is return on capital employed? How do we compute return on capital employed?
It's profit before interest and tax over long-term capital.
No, please. Profit before interest and tax divided by total capital employed.
All right, sir.
Don't say long-term capital.
Over what, sir?
Okay, you might be correct. You might be correct. Over long-term capital. Your long-term capital is equity capital and long-term debt. Yeah, you might be correct. But I would prefer to say my return on capital employed is profit before interest and tax divided by capital employed. The capital employed is equity capital and long-term debt.
Sorry, sir. Did you say the capital employed is long-term debt and what again?
No, initially he said long-term debt. I was like, no, it's wrong, but it's not actually wrong. Your capital employed is shareholders' funds. Shareholders' fund plus long-term debt. Both shareholders' funds and long-term debt, they are categorized as long-term capital. Is that clear, please?
Yes.
All right, sir.
Èmi wá fi ṣe chairman lọ́dún yìí báyìí. Wọ́n ti ní gbogbo ẹni tó bá lọ́mọ nù wa ọmọ rẹ̀ gbọ́dọ̀ apply. Kọ́mọ̀dé pé bọ́yá àwọn ọmọ wọn ni wọ́n ti fi question wọn.
All right, Mr. Jamiu, your discussion will be recorded. So it's better to manage your private affairs. All right. Our profit before interest and tax. For the current year, 42,000. Total capital employed, $200,000. You can compute here. We can compute this, Abby.
Yes, sir. The answer is 21.
Thank you. 42,000 divided by 200,000 multiplied by 100. That will give me 21%. For year one, $51,000 divided by total capital employed year one.
215,000.
That's not correct.
17.59%.
290.
290.
51 divided by 290. 17.59.
59%.
284,298.
17.59%.
Thanks.
For year two, capital employed 284,218. Operating profits. 60,000. 60,000 divided by 284,218.
21.11%.
21.11.
11%.
Year 3, 96,000 divided by
69,000, not 96.
Oh, 69, thank you. 69 divided by 282,655.
24.41%.
See?
24.41%.
Here we have 21.11, 24.41. Year 4, 285,311. 78,000.
27.34%.
27.
0.43%.
Okay,
0.34, not 40.
27.43. I'll keep it.
27.34.
27.34.
Yes, please.
For the final year, 78,000 divided by 313,811.
24.86%.
86%.
27.34, 24.86. We have computed the required ratio. You are done with requirement A. Something like this might be in your exam. Oh. Something of this nature might be in your exam.
But you're not going to be compulsory.
I don't know what to say. Because ratio is one of the things you can get the full marks. Ratio, financial ratio, is the environment you can leverage on. If somebody is saying it's not compulsory, is it because of capital you want to leverage on? You need to understand how to get your marks out. Cost of capital is deep. There are some topics that you should pray that it should come out. So I wouldn't know if it's compulsory or not. Examiner can decide to pick any question as compulsory. But in my own opinion, speaking as a person, financial ratios is something I can quickly pick my mark. Interest cover ratio. Take profit before interest and tax, divided by the interest expense. You are done. Return on equity. Pick your profit after tax. Divide by shareholders' funds. What is the challenge? Ability to prepare income statements. Imagine you are the owner of the business. You want to take a loan. and bank said, we are going to give you $100,000 loan. Repay us $25,000 every year and give us interest of 9%. Imagine you are the one collecting the loan. Are you saying you cannot compute the interest yourself? 9% of my opening balance. If I repay part of the loan, will I pay interest on it? I collected $100,000 loan in year one. I paid $25,000. That means that $25,000 has been paid. Interest will only be computed on outstanding debt. All right. So I don't know if it's going to be compulsory or not. All I know is that there's every possibility that your question will involve financial ratio analysis. Requirement B. Examiner says comments on the financial implication for AIMBA of accepting the loan on the terms indicated above. Now, assuming you are the accountant, you are the financial manager of AIMBA, and a bank is offering you $100,000 loan with annual interest of 9% and a repayment of $25,000 every year. What will be your concern? As a finance manager, what are your concerns? Your concerns will be the terms of the loan. Can we meet repayments every year? And can we pay the interest every year? That should be your concern. If my company should collect $100,000 loan, and every year we are going to pay $25,000 loan, my concern will be, will my company be able to repay this loan every year? Do we have enough cash to meet repayment of the loan every year? That should be your first concern. Because failure to repay the loan, the bank can terminate the life of your business. Examiner says, comments on the financial implication of accepting the bank loan on the terms indicated above. You know, you have to project yourself as the finance manager. I'm very sure that almost everybody on this platform is either a university graduate or an HND graduate. And that qualifies you to be a finance manager. You have to project yourself that this is what I can do. Now imagine you are the finance manager and your MD is asking you, we want to collect a loan of $100,000. We need to repay the loan in 4 years at a repayment of $25,000 each year. The manager now asks you, what are the risks involved? What are the concerns? You are going to ask your MD, please, sir, let us check our liquidity. Do we have enough cash flow to meet annual repayments and the annual capital repayments and the interest payment every year? Examiner says in the question, but these are questions that text, it takes your financial reasoning. Examiner says, Enyimba currently has no debt other than the existing and continue overdraft and has no cash or near cash investments. Question that will text your financial reasoning. If a company does not have cash or near cash currently, I will now ask myself, with the new projects, with the expansion, we are taking the loan. The loan will be used for expansion. I will now ask myself, would the expansion generate enough profits or enough cash flow? Are we going to get enough profits or enough cash flow from the expansion? Because annually we are going to be repaying the loan. And currently, we don't have cash flow. You now need to ask yourself, will this expansion in business give us cash flow? Because we require cash flows to repay the loan. Let's go to this. Enough of discussion. Now look at the business. We are going to get profit after tax from the business. Then we are going to pay dividends. That means the only money we are left with is the retained earnings. If you pay dividends, that means the only profit retained, the only money the company is left with is our retained earnings. Assuming retained earnings equal to cash, let's go to this. Retained earnings for year 1. We are not bothered by year 0 because year 0 we have not obtained the loan. We are going to obtain the loan in year 1. Now go to this. Please note the retained earnings. I'll require it. 15,019,218. Let me go to this. Look at the comments here. Assessment of Enyimba to meet annual loan repayment terms. In year 1, we have retained earnings, $15,000. Year 2, 19,218. Year 3 and year 4. The loan must be repaid within 4 years. Year 1 to year 4. That is why we are picking year 1 to year 4. Retained earnings for year 3. Year 1, year 3. 23,437. And year 4. 27,656. Year have 23,437. 27,656. Assuming our retained earnings is equal to our cash available. In year 1, we are supposed to repay $25,000. Year 2, $25,000. Year 3, $25,000. Year 4, $25,000. Look at it. Where is this coming from? Look at the loan amortization schedule. Capital repayment, 25, 25, 25, 25. That is the terms of the loan. The terms of the loan says that the loan must be repaid $25,000 each year. Look at it, please. Anybody repay the $5,000 of the loan each year for the next 4 years. We now come here. Obviously, in year 1, we don't have enough profits or enough cash flow. This will give me negative. That means we can't meet repayment in year 1. Here also negative what? Negative what, please? 19,218 minus 25,000.
5,782.
5,782. Year 3, negative what?
1,563.
Year 4, positive. Positive what? 2656.
2656. Positive 2656.
Now look at this. Do you think the company should take the loan?
No.
You don't have enough retained profits to finance repayments. That means we don't have enough cash flow. Your comment here will be, let me expand this. The comment here will be comments. Eyimba does not have sufficient retained profits to meet the loan repayments conditions. Your comments here with me. Enyimba does not have sufficient retained profits to meet the loan repayment condition. So if you are looking at this, we can say don't take the loan. If you are looking at this analysis, we can conclude that Enyimba should not take that loan on the terms indicated. But what can we do to resolve this problem? Because we require the loan for expansion. Look at dividend payments. Our duty is not only to calculate figures. We also provide solution to problems. We can't just say don't take the loan, because business requires finance for expansion, and the expansion will generate profit for us. What can we do to meet repayment terms? Now look at this.
Okay.
50% dividends. Must you pay dividends? Is dividend payment compulsory? We have treated dividend theory. Is it mandatory for company to pay dividends?
No, sir.
Not mandatory, sir.
You are paying dividend to shareholders. Meanwhile, you have loan repayment to finance. Payment of dividends, and you are now paying 50% of your profit. We can adjust the dividend payments. We can change our dividend policy, because the business needs to expand. Our duty is beyond computing figures only. Accountants, we are integral parts of the company's management. And unless you project yourself in that direction, I understand the fact that passing the exam is a prerequisite for certification. I'm aware that the first objective is to pass this exam. But the long-term objective is the ability to provide sound reasoning. May God give us a better understanding.
Amen.
Amen.
Amen. Thank you, sir.
Let's return back to the computation. All right. Look at the comments here. Possible actions that could be taken if the company accepts the loan. The company dividend policy can be changed. The company can reduce dividend payable to shareholders. it appears that the company maintained a constant dividend payout ratio. A change in dividend payout ratio should succeed, since Eyimba is an owner-managed private business. Eyimba Limited is an owner-managed business. The owner is managing his private business, and you are paying yourself 50% of your profit as dividend. Now that you have obtained a loan, you can easily change the policy. In this case, before you pay dividends, settle the loan first. Look at it. The impact of changing dividend policy. You have the year 1, year 2, year 3, year 4. Go and pick your profit after tax. Before you pay dividends, first of all, settle the loan repayments. Here we have $30,000. The profit after tax for year 1. Year 1 part, $5,000. Year 2, 38,437. It's just 1 minute. Where's my... Oh, I'm trying to get my pen to reduce. Don't get it here. To reduce movement up and down. 38,437. Yeah, 38,437. Yeah, 46, not 47. 46. I can't remember the figure again. Eight,
46,875.
Then year 4, 55,312. Eight, 7, 5, 55,312.
312.
I will now pay loan repayment first. Loan repayments, 25,000 to be repaid here.
Yearly.
25,000 here. 25,000 here. 25,000 here. We are going to repay the loan first before paying dividend to shareholders. Balance the difference. This is 5,000. Difference here.
13,437.
437. Balance here.
21,875.
Balance here.
3312.
3312. The company can now decide. Look at it now. You have profound solution to the problem. That look, if you want to take this loan, reduce dividends in year 1, year 2. So that you can meet your loan repayment. Look at the comments here. If the company is willing to accept the loan on the terms indicated above, it may have to change its dividend policy. The company can reduce dividend payable in year 1 and year 2. In order to meet annual repayments term. You are trying to give alternative solution. Lastly, financial implication. Financial implication of accepting the loan. On the terms indicated above. Let's go and look at the ratio. Look at interest cover ratio. Currently, the interest cover ratio is 21 times. Currently, our interest cover ratio is 21 times. If you accept the loan in year 1, the interest cover ratio will fall. Year 2, if you pick up. In year 1, the financial risk of the business will increase. A reduction in interest cover ratio implies increase in financial risk. In year 1 also, the company's gearing ratio will rise. Return on equity will fall. Return on shareholders on capital employed will also fall. The major problem is year 1. The major implication is in year one. Look at it. Look at the comments here. In year one, Enyimba financial risk will increase significantly as a result of fall in interest coverage ratio and rise in the debt to equity ratio. Please, can you mute? Laura, you can have your discussion, but mute. Return on equity and return on capital employed we also fall in year one. Year one is the major concern. Subsequent years, in brackets, year 2 to year 5. This ratio will improve. These ratios will improve. Financial risk will reduce. Financial risk will reduce. And return to shareholders we improve significantly. So, final conclusion. What will be our conclusion? Should Eyiba accept the loan or not? Yes, our final conclusion. Should Eyiba accept this loan or not?
All right, let me say something. Because of expansion of the business, the Eyiba should accept the loan, since we are going to change our dividend policy on the fourth year. We are going to pay off the loan, so they should accept it.
All right, that's a good one. Any other comments?
Okay, I'm also in support of that Eyiba should accept the loan on the condition that if they reduce their or they change their dividend policy, and for the fact that the company want to expand, and the expansion may, in the long run, bring more money to the shareholders.
Bring more income to the business.
Income to the shareholders. So that means that the dividend lost today or reduced today, they can still gain it in future when the business is being expanded properly. So they need to accept it.
That's fine. That means in the first year we suffer the pain, but subsequent year we stand to benefit more. That's good one.
Yes.
So you can take your conclusion. Eyimba Limited can or should accept the loan on the terms indicated above. An adjustment and adjustments in dividend policy we provide funds for the loan repayment. For the loan repayments in subsequent year, the owners will benefit more. In subsequent years, the owner will benefit more. All right. We are done with the question. Any question, please?
Yes, sir. There's a question, sir. Hello, sir.
Yes, I'm all here. You can ask your question.
Okay. In the first calculation we first of all made, we make use of 9%, and then which I don't understand how we get the 9%. That's what I'm trying to understand, sir.
Do you have the question with you?
No, from the question we solve, sir. Under the new loan, we make use of 9%.
And now, do you have the question with you at home?
Yes, sir.
Can you read the question for us?
No problem, sir. Eyimba Limited is a small, profitable, own-managed business which is seeking finance for a planned expansion. A local bank has indicated that it may be prepared to offer a loan of $100,000 at a fixed annual rate of 9%. Okay, sir.
So come here. I'm already tired, me. So once you are done, so I always advise open the question on your seat. So any other comment, any other question? All right, on this topic, we have treated 3 questions. You can look at the last question. Question number 4. Please, you can attempt this question to tell yourself the extent to which you are able to follow the class. You can go through this question and attempt it. All right, we shall close here tonight. By God's mercy, next week, we move to another topic. Let's have a blessed evening. May God enrich us in knowledge and understanding.
Amen.